How many times does this happen to you, where you observe a ranging sideways market that respects every support and resistance? You see that it has worked in the past setups, just to enter exactly when it stops holding, essentially stopping you out from your trade. And the most frustrating thing is when after it moves into your take profit, but you were already stopped out from your position. In today's video, we will explain the simplest smart money trading strategy that involves trading setups around sideways zones. As the video goes, the difficulty will increase. So we start with a beginner-friendly introduction. Let's get into it. The strategy we are going to talk about today involves a simple smart money concept named buy-side liquidity and sell-side liquidity. The buy-side and sell-side liquidity play an important role in the movement of a market. Prices typically move towards these zones. The market constantly ranges between sell-side and buy-side liquidity, much like a continuous cycle where price transitions from sell-side liquidity to buy-side liquidity, and then the opposite way around, going from buy-side liquidity into sell-side liquidity. These zones can be used as a roadmap in our chart analysis, helping us stay one step ahead of the market and gain a more clear view into potential trading setups that we can look for. What we need to know is that a market's price affects the psychology of participants. The market plays with their mind, and the human mind is very sensible to emotions. Notice how we use the term market participant and not traders. That is because the psychology can be applied to all financial markets. So let's go into explaining the psychology behind them. Imagine price entering the accumulation phase, where equal highs and lows are formed before a break to the upside or a break to the downside. In this accumulation phase, there is a support level at the bottom and a resistance level at the top. Retail traders do usually look to buy at the support level and place their stop losses below it, creating a substantial liquidity pool below the support. This liquidity pool includes sell stops from traders expecting a breakdown below support. On a similar manner, at the resistance level, many retail traders place sell orders and place their stop losses above the resistance. They want to look for a price breakout. These actions gather a liquidity pool of orders above and below the equal highs and lows. Buy-side liquidity is located at the top of the accumulation phase, and sell-side liquidity is at the bottom. Essentially, buy-side liquidity is where buyers place buy stops and short sellers set their stops, while sell-side liquidity is where long traders place their stops and short sellers place their sell stops. So let's see how the market reacts at the buy-side liquidity and sell-side liquidity. Assuming the price is approaching equal highs and retail traders are selling, placing their stop losses above the resistance. If the price breaks through the resistance, it triggers retail stop losses and generates buying pressure, triggering buy stops. This creates an increase in buying orders, which incentives traders to keep opening buy orders. Every buy position in the market requires a corresponding seller, and every seller in the market requires a buyer. So essentially, every order opened needs a counter order to fill that certain order. Large financial institutions, or so-called the smart money, need a significant number of sellers to execute large buy orders. Smart money often triggers stop loss and buy stop orders in the market to execute these positions. When smart money looks to open sell orders, they need a counter order of buyers, and often the market is manipulated to create scenarios that deceive traders. This manipulation makes traders believe they are on the right side of the market, only for the market to move towards their stop loss levels, continuing the trend afterwards, leaving the unfortunate traders with a loss, but most frustrating, going into their take profit after the position has already been closed with a loss. Let's consider smart money executing a large sell order. As the price moves towards buy-side liquidity, it breaks through the resistance, triggering retail stop losses and activating buy stops. This influx of buying orders allows smart money to execute sell orders, pushing the price into a breakdown phase. This scenario demonstrates how smart money uses buy-side liquidity to influence and manipulate a market's price action. Now, let's talk about identifying sell-side and buy-side liquidity through candlestick patterns and scenarios on the chart. Swing levels are potential liquidity areas. A candlestick swing low occurs within a three-candle sequence, where the lowest point is between two higher lows. In a similar manner, a swing high occurs when the highest point is between two lower highs. Traders usually place stop losses at recent swing highs and lows, basically gathering a pool of liquidity in a small area, making it attractive for smart money to use those areas into their advantage. As presentation before jumping into the chart, what we want to look for is for price to essentially break a swing level and then immediately return back. So for the buy-side liquidity, we look for price to go up, break a swing high, and immediately reject to the downside back below the break. And for the sell side, we look for the price, go break a swing low, and immediately come back up above the swing low. This is what we want to see on a chart. So basically, we are looking for liquidity hunts. And let's go into applying it on the chart. On the GBP against the US dollar in the 1-minute time frame, the market was coming from a downtrend, and we can see how it slowed down the bearish momentum and made a higher low. This gives us a good first information that the continuous downtrend is close to an end, and the market might look to either pull back and consolidate, or to break up to the upside. And from those options, we got the consolidation. The market has been going sideways shortly after, and we mark the resistance area and the support area. These areas have been creating sort of equal lows and highs. So respecting our plan that we have said in the last minutes, we wait for a breakdown of the sideways action, or we wait for a breakup of the sideways action. And we got the breakup. This red candle is a valid reversal signal, but sell shorting right after it prints it can get dangerous given the fact that this market has been lately going into a mini uptrend. And the price shot up, just for it to come back down. The momentum of candles also gives us a huge signal that this is probably just going to keep dumping down, because the price action looks very aggressive. So after the market liquidated sellers that had their stop losses right above the resistance, and buyers opened their orders, the market makers now use the liquidity from the buyers to take the price down. And on these types of setups, it can help if we know how to use liquidity structures and entry models. But we don't have an important one in this setup. We only got a low-quality breaker block, but it didn't even got mitigated, so it's worthless. The most simple setup is sell shorting the past resistance. Retail traders think that a resistance that got broken flips into a support, but that's rarely the case. And what often happens is the market traps those buyers and stops them out. Sellers taking revenge now. So sell shorting right on the resistance after price came all the way back down to it, the stop loss above the last high, take profit below the past support, because below the support is where the buyers have set their stop losses. And the risk to reward is not high. This is why I personally don't trade these zones often, because it's hard to have a risk to reward ratio of above 1-2 or 1-3. But even that, it's fine. And that was the first setup. Another example on the GBP against the US dollar. We have seen the highs and lows formed that forms a resistance and a support. So the price is moving sideways around these two zones. We wait for a break either to the upside or to the downside. Doesn't matter which way, because the very important thing is that we do not try to predict where it will break. We will just look for price action clues to trade against the first breakout. So let's check the price action itself. The breakout was to the upside. The price came back to retest the zone and looks to be continued the recently started uptrend. Now it's simple because we got two options depending on what the price does. If the uptrend continues, we just ignore this setup and move on. The second option is if price breaks down to the previous resistance. We look to sell short it, just like in the past setup. And in this situation, we could not get a perfect entry from the top of the zone. That would have been possible only if we lowered the time frame after the breakdown. But to keep it as simple as possible, I will look forward to the worst case scenario. The case where we got the opportunity to place the sell short order after the first large candle. So essentially, we took a lower quality entry. But I will still look for a decent risk to reward ratio. So the stop loss right above the resistance in this case, and the take profit below the last swing low, so right below the previous support area. And this trade got closed much faster because of the increased momentum, and still got a decent enough risk to reward ratio of 1-2. And a quick recap of what we have learned. So we got a consolidation. If the price breaks up, then comes back down, we look to sell short at the first aggressive candle that has hit the resistance. We first place the take profit below the support, expecting buyers to get their stops liquidated, and after setting the take profit, we look for the stop loss. This order allows us to see if the trade can give us a good enough risk to reward ratio. The minimum I would look to execute a trade on sideways zones are 1 to 1.5 risk to reward ratio, and mostly the most preferred target would be a 1 to 2 risk to reward ratio. And this allows us for a dynamic stop loss. It can be above the last major high or above the last internal high. And if the sideways market breaks to the downside, we are looking if price manages to break up into the support again with an aggressive momentum and buy long that certain candle. Now we are looking for the market to liquidate the seller's stop losses. And the order for the targets are the same. First, the take profit above the resistance. Then the stop losses can be placed either below the major low or below an internal low. If you want to level up your trading skills, look forward to the link in the description where we can help you get to a funded account using these strategies. Thank you for watching. If you liked it, leave a like and feedback in the comments. See you in the next one.